Well, it's official. We're going through some really hard times in the stock market the last couple of weeks. Actually, since the beginning of the year. Okay, I can understand that times like this can make you really emotional, anxious, disappointed, and thinking if the good times of profits have come to an end. And it's not just you. One of the biggest names in finance and investing community in YouTube, Mr. Meet Kevin, decided to sell all his investments recently, but more on that later. So things are going a bit crazy lately. But trust me on this, there will be a time in the future when you're going to look back at this exact moment and laugh really, really hard with your reactions. Or cry out loud if you decided to press that sell everything button. So today I want to give you some really good reasons why you should not start hitting your head on the wall, along with a couple of strategies and actions you can follow for dealing with this admittedly unpleasant situation we all face and find the strength to move forward. So, take a deep breath, clean your mind from all those bad thoughts, and let's do it. Okay, I'm gonna start with the bad news first so we can get those right out of the way. Since the beginning of the year and at the time of recording this video, the S&P 500 lost almost 9%, the Dow 5%, and the Nasdaq almost 50% of its value. And you can add more to this number if we look at the losses of the three indices from the all-time highs. High inflation, imminent rate hikes from the Fed, bonds yields rising, Omicron variant and supply chain bottlenecks have all led to a fearful market where panic selling has dominated and investors are trying to save their money or even worse, time the market. I have already addressed why timing the market is the worst thing you can do, and you can find my detailed video in the description below, but I want to make it perfectly clear one more time. It is impossible to actually predict what the market is going to do, and there's no way I or anyone else can tell you what is the best time to buy or sell. But after saying that, let's look a bit more in depth at the behavioral side of things and why things escalated so quickly. When it comes to money and investing, we are not always as rational as we think we are, which is why there's a whole field of study that explains our sometimes strange behavior. Standard economic theory is based on the belief that individuals behave in a rational manner and that all existing information is embedded in the investment process. This assumption, known as rational actor theory or RAT, is the essence of the efficient market hypothesis. According to RAT, individuals rely completely on rational calculations to make rational choices that result in outcomes aligned with their own best interests. RAT supposes that rational actors make these rational choices based on error-free calculations, given full and complete information that is always available to them. So, rational actors in a way try to actively maximize their advantage in any situation and consistently try to minimize their losses in a self-interested manner. Researchers, however, have been questioning the RAT assumptions and have uncovered evidence that rational behavior is, in fact, not nearly as prevalent as we might be led to believe by mainstream economics. Behavioral finance attempts to understand and explain how human emotions influence financial and investment decision-making processes, and you may be surprised by what they have found so far. In 2001, Dalbar, a financial services research firm, released a study titled Quantitative Analysis of Investor Behavior, which concluded that average investors consistently fail to achieve returns that beat or even match the broader market indices. The study found that in the 17-year period to December of 2000, the S&P 500 returned an average of 16.29% per year, while the typical equity investor achieved only 5.32% for the same period, a startling 9% difference. It also found that during the same period, the average fixed income investor earned only 6.08% return per year, while the long-term government bond index reaped 11.83%. And it doesn't even stop there. In a 2015 follow-up of the same publication, Dalbar again concluded that average investors failed to achieve market index returns. It found that the average equity mutual fund investor underperformed the S&P 500 by a wide margin of 8.19%. Also, average fixed income mutual fund investors also consistently underperformed, returning 4.81% less than the benchmark bond market index. So why does this happen? Well, behavioral finance provides some possible explanations. First of all, there's the fear of regret. Regret theory deals with the emotional reaction people experience after realizing they've made an error in judgment. Faced with the prospect of selling a stock, investors become emotionally affected by the price at which they purchase the stock. So they avoid selling it as a way to avoid the regret of having made a bad investment in the first place, as well as the embarrassment of reporting a loss. After all, we all hate to be wrong, don't we? What you should really ask yourself when contemplating selling a stock is this: what are the consequences of repeating the same purchase if this security was already liquidated, and would you invest in it again? If the answer is no, well, it's time to sell. Otherwise, the result is regret in buying a losing stock and the regret of not selling when it becomes clear that a poor investment decision was made, and a vicious cycle where avoiding regret leads to more regret. Regret theory can also hold true for investors when they discover that a stock they had only considered buying has increased in value. Some investors avoid the possibility of feeling this regret by following the conventional wisdom and buying only stock that everyone else is buying, rationalizing their decision with, well, everyone else is doing it. Oddly enough, many people feel much less embarrassed about losing money on a popular stock that half the world owns than about losing money on an unknown or unpopular stock. So the second type of behavior is a thing called mental accounting. Humans have a tendency to place particular events into mental compartments, and the difference between these compartments sometimes impacts our behavior more than the events themselves. Okay, say for example, you aim to catch a show at the local theater and tickets are $20 each. When you get there, you realize you've lost a $20 bill. Do you buy a $20 ticket for the show anyway? Behavior Finance has found that roughly 88% of the people in this situation would do so. Now, let's say you paid for the $20 ticket in advance. When you arrive at the door, you realize your ticket is at home. Would you pay $20 to purchase another? Only 40% of respondents would buy another. Notice, however, that in both scenarios, you're out $40. Different scenarios, the same amount of money, different mental compartments. Duh! An investing example of mental accounting is best illustrated by the hesitation to sell an investment that once had monstrous gains and now has a modest gain. During an economic boom and bull market, people get accustomed to healthy, although paper gains. When the market correction deflates investors' net worth, they're more hesitant to sell at a smaller profit margin. They create mental compartments for the gains they once had, causing them to wait for the return of that profitable period. Next one is loss aversion. Okay, it doesn't take a neurosurgeon to know that people prefer a sure investment return to an uncertain one. We want to get paid for taking on any extra risk. That's pretty reasonable, right? Well, here's the strange part. Prospect theory suggests people express a different degree of emotion toward gains than towards losses. Individuals are more stressed by prospective losses than they are happy from equal gains. An investment advisor won't necessarily get flooded with calls from her client when she's reported, say, a $500,000 gain in the client's portfolio. But you can bet that phone will ring when it posts a $500,000 loss. A loss always appears larger than a gain of equal size. When it goes deep into our pockets, the value of money changes. Prospect theory also explains why investors hold on to losing stocks. People often take more risks to avoid losses than to realize gains. For this reason, investors willingly remain in a risky stock position, hoping the price will bounce back. Gamblers on a losing streak will behave in a similar fashion, doubling up bets in a bid to recoup what's already being lost. So, despite our rational desire to get a return for the risks we take, we tend to value something we own higher than the price we'd normally be prepared to pay for it. The loss aversion theory points to another reason why investors might choose to hold their losers and sell their winners. They may believe that today's losers may soon outperform today's winners. Investors often make the mistake of chasing market action by investing in stocks or funds which gather the most attention. Research shows that money flows into high-performance mutual funds more rapidly than money flows out from funds that are underperforming. Okay, the fourth piece of this behavioral puzzle has to do with misjudging our own emotional state or abilities. We get optimistic when the market goes up, assuming it will continue to do so. Conversely, we become extremely pessimistic during downturns. Placing too much importance on recent events while ignoring historical data is an over or under reaction to market events, which result in prices falling too much on bad news and rising too much on good news. At the peak of optimism, investor greed moves stocks beyond their intrinsic values. I mean, when did it become a rational decision to invest in stock with zero earnings and thus an infinite price to earnings ratio? Extreme cases of over or under reaction to market events may lead to market panics and crashes. We sometimes also overestimate the precision and veracity of our knowledge, as well as the perceived superiority of our own knowledge relative to others. Many investors believe they can consistently time the market, but in reality there's an overwhelming amount of evidence that proves otherwise. Overconfidence results in excess trades with trading costs denting profits. Now, having said all this, I just want to coach a bit on what I referred to at the beginning of the video about Meet Kevin sold everything. Okay, I understand that it was a shock for his followers since before then he was evangelizing the buy the dip strategy. Of course, I cannot and will not tell anyone what to do with his or her money, but I would like to give you my thoughts on this. I believe that the reason behind this massive sale is poor investment decisions and lack of financial planning. Because when you have a plan in place for the amount of money you're going to need in the near future, and you do not falsely buy every single dip the market can offer, you have nothing to be afraid of. On the contrary, Meet Kevin was doing none of this, and this is why I believe he made this decision, even if he's trying to convince us otherwise. The truth is that dealing with everyday market fluctuation is quite hard and needs a good financial plan and a strong stomach. There is actually a great book from Morgan Housel, The Psychology of Money, where Housel mentions 3 great insights that I would like to share with you. Number 1 is your personal experiences with money make up maybe 0.0000001% of what's happened in the world, but maybe 80% of how you think the world works. Every decision people make with money is justified by taking the information they have at the moment and plugging it into their unique mental model of how the world works. Their view of money was formed in different worlds. And when that's the case, a view about money that one group of people thinks is outrageous can make perfect sense to another. Number 2 is time is the most powerful force in investing. Good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that can't be repeated. It's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild. Number 3 is getting wealthy versus staying wealthy. Good investing is not necessarily about making good decisions. It's about consistently not screwing up. Getting money requires taking risks, being optimistic and putting yourself out there. But keeping money requires the opposite of taking risk. It requires humility and fear that what you've made can be taken away from you just as fast. It requires acceptance that at least some of what you've made is attributable to luck, so past success can't be relied upon to repeat indefinitely. The ability to stick around for a long time without wiping out or being forced to give up is what makes the biggest difference. This should be the cornerstone of any strategy. Planning is important, but the most important part of every plan is to plan on the plan, not going according to plan. Many bets fail not because they were wrong, but because they were mostly right in a situation that required things to be exactly right. Room for error, often called margin of safety, is one of the most underappreciated forces in finance. It comes in many forms: a frugal budget, flexible thinking, and a loose timeline. Anything that lets you live happily with a range of outcomes. Finally, reasonable versus rational. What's often overlooked in finance is that something can be technically true, but contextually nonsense. A rational investor makes decisions based on numeric facts. A reasonable investor makes them in a conference room surrounded by co-workers you want to think highly of you, with a spouse you don't want to let down, or judged against the silly but realistic competitors that are your brother-in-law, your neighbor, and your personal doubts. Investing has a social component that's often ignored when viewed through a strictly financial lens. Okay, now down to what I am going to do this year and what my investing strategy is for 2022. Well, to be honest, I have started formulating my strategy since December of last year, after the big fat rally we had in the market that got me really skeptical about a potential downfall. I was really heavy in tech and growth stocks at the moment, with most of my money being into stocks like Tesla, AMD, Cloudflare, Shopify, and ETFs like LIT, TAN and ARK. Don't get me wrong, most of the stocks were doing great since I bought most of them in 2020, but since the uncertainty of 2022 with the Fed being so hawkish and inflation still up, I made a decision to protect myself and move my money into less volatile index funds. So at the moment, the majority of my portfolio is in VTI along with international stock funds, and I still own some Tesla, Apple and Amazon from individual stocks. What I will do for the rest of the year is that I'm going to DCA into these funds until we have a better idea of where rate hikes going to end and where inflation is heading. Then probably I will start buying into growth again. But what I'm interested more right now is keeping my wealth than make more money. Okay guys, that's all for today. Thank you very much for watching and see you all next time. Bye bye.